this is a little review from the last chapter. We had this thing called the trial balance, okay? And we had the unadjusted versus the adjusted. So what was the difference? What changed between the unadjusted and the adjusted trial balance? Does anyone want to share their thoughts? Now I got my seating chart here. So what about Wyatt? What do you think? Well, what changed the balances, right? We had unadjusted balances. What did we do to change balances and then require us to kind of recompile all the balances? Yeah, adjusting entries. Okay, so we had the unadjusted balances. We did all these adjusting entries for deferrals and accruals, right? That was the reason why we did them, but they're called adjusting entries. And then that we changed the balances, and we then had this recompilation called the adjusted trial balance. And this adjusted trial balance is arranged in a way that groups the accounts by what financial statements they're going to go on, right? So at the bottom, we had these income statement accounts. So you can see all the revenues and all the expenses are here. And then we added in dividends. So all these debits and credits kind of get netted together into retained earnings. And then we had all these other accounts, and then all these other accounts from the balance sheet. And then we also incorporated all this stuff into the retained earnings, which completes the balance sheet. Okay, so this is not just BS. Okay, this is actually how the accounting software works. Okay, so let me show you that. Okay, so this is again just some free accounting software. QuickBooks is going to be the same. You know, your enterprise level, you know, what a big company uses, it's going to be something similar to this. Okay, so if I go to this reports, this is a company, actually, let me just show you this. So this is a company I just made up. So I just have all these these are all journal entries. Okay, I just made up a company, and I just made a bunch of accounting entries as if the company is a real company. It has revenues, expenses, it's bought assets. This is just a list of all the different journal entries that have been entered into the accounting system, just like we did in chapter 2. Okay, and so if I go to this reports, they will have the trial balance. Okay, so it's exactly as we talked about. It has, and they're doing actually a little better job arranging things because it has the assets. You can see they're all debit balances. The liabilities. This is a debit balance. This is wrong. So we would want to see what is going on here. Okay, anyways, I'll fix this. Anyways, I just wanted to show this to you because really this trial balance is like a real thing, okay? And it helps you find problems. I just found a problem in my books, right? I'm gonna have to go back and figure out how to fix that. Okay, so you as an accountant will do all your journal entries. I saw that there's a mistake because I know liabilities should be a credit balance, right? We agree with that? So that's how just reviewing this, I quickly was able to see a mistake. So, this is the kind of stuff that a accountant is going to have to be familiar with. You should, hopefully see a mistake like that and know that there's something that was entered incorrectly. Okay. So that's why this stuff is useful. Okay. So, but again, you can see that it's all arranged by kind of what financial statement it's going to go on. Okay, again, so the equity accounts, I don't have any revenue or expenses listed here, and I did this like a couple weeks ago, so I gotta go review exactly. Oh, okay, here we go. So there is some income. It's just the period I was looking at was the wrong period. Um, so you can see I have revenues, expenses, common stocks. So there's some contributed capital. Um, since this is only looking at 2024, you see that they're calling retained earnings profit from all prior years. Okay, but that's essentially like the beginning balance of retained earnings. Okay, and then we're adding, of course, the income and expenses from this year, and we would update that and the dividends. You can still see here that it balances, even though I have this mistake. So I must have uh, incorrectly debited accounts payable this should be actually tax expense, because I think what I did was I did debit taxes payable, credit cash, right? Why is that wrong? It should be tax expense, right? So that's, I think, what I did incorrectly. So I have to go back and fix that. Okay. Um, okay. So anyways, so we should be, this is kind of where we ended chapter 3. Okay. With this adjusted trial balance. Um, Now, when we organize these accounts into a balance sheet, we talked about different ways that you organize your assets, liabilities, and equity. Okay. So the first kind of distinction or way of organizing is current versus long term. Okay. The cutoff point is 1 year. So any asset that you're going to benefit from in the next year or sooner is going to be a current asset. Okay. Any liability that you're paying off within a year is also a current liability. Anything that's over a year, either one of those, is going to be long term. Okay. So 1 year is the cutoff. Okay. The other way that we organize our balance sheet is by type. So we'll have our current assets kind of listed together. We'll have our property, plant, and equipment assets listed, investments, intangible assets like goodwill. They'll all be listed kind of in a grouping. Okay. And it's the same thing with the liabilities. And this is to make, again, our balance sheet more readable. The balance sheet is meant to convey information about our business. And so it should be a little organized, right? Uh, it should be presented in a way that's coherent and that will make sense to our financial statement reader, rather than just like randomly listing stuff. Okay, that is like all out of order, not really. There's no method of why the accounts are listed. That's like not going to be as usable. Okay, so this is all in the service of making the financial statement more readable. Okay, and then the next way we organize things is by liquidity, and so you'll see like within current assets are usually listed first. What's the most liquid current asset? Cash, right? So cash is most often going to be listed as the first asset on a balance sheet, because the balance sheet will list the assets, it will have the current assets, and then we'll have the most liquid current asset, which is cash. Okay. And then it will decrease from there. So it'll usually go accounts receivable, and then inventory, and then other receivables. So it's going to be listed in that kind of order of liquidity. And then the other one is seniority. Okay, so what this means is uh, it relates to especially your liabilities and your equity. Actually, it only really relates to your liabilities and equity. Seniority has to do with if things go bad, who's going to get paid first. Okay, so is it good to be more senior or less senior? What do you think? Okay, and who do you think the more senior, let's say, lenders are earning a higher interest rate or a lower interest rate than the junior ones? Higher? Why? Why would they earn more? What is the rate of return correlated with? Why should you earn more money if you're investing in something? Okay, importance. I like that. Okay, but uh, if you're playing roulette, why do you make more betting on like a single number versus like betting on red, right? I think the payoff for like betting on a single number and getting is like 38 or something. While if you bet on just like red or black, you just get 1 to 1. Why is that? Exactly. It has to do with risk. Okay. So who is taking more risk, the senior lender or the junior lender? Who's taking more risk, senior or junior? If the senior lender is going to get paid first if things go badly, is that less risky or more risky? It's less risky, right? It's like they're getting the first money to come out of the business, right? They're the first people that are going to get paid off. So they're taking the least risk, and therefore they're going to make the least return, okay? The equity holder, the shareholder, is taking the most risk. That's why stocks typically, on average, return more money. But each individual company, there's a lot of bankruptcies that happen too. So on a individual company, you can lose all your money, right? Even though the senior lender to that business may walk away with all their money, right? So the equity holder is going to take the most risk, but they're going to get the most return if things work out. Even within equity, there is seniority. There is something called preferred stock, okay? That's a class of stock that's actually more senior than common stock,